Hey there, everybody. It's Bob, a Trade Genius. Got my good friend Phil here. Janet Yellen may have won the battle, but she's going to cause us all to lose the war. Stay tuned.
Trade Genius.
Hey guys, we got Black Friday specials. They're really cool. We have the best pricing for the year. You can get our basic package, our advanced packages, our VIP rooms, software, trade options, trade crypto, trade the futures. With us, get our indicators, best prices of the year. Take advantage of it. Thanks for listening. Okay, Phil, really fascinating stuff. I know we've been touching upon this. Everybody and their brother knows the market did a 10% splooge higher here in 2 weeks. Fairly unprecedented, but there's a reason for that. And I want to throw it over to you. I want you to show these couple charts to people because this is what manipulation looks like. And it's like a sugar high, short-term good, long-term pain. So I'm going to throw it back to you.
Yeah, so let's go over to some charts here. So first one is the Goldman Sachs U.S. Financial Conditions Index, otherwise known as FCI. And as you can see, the Fed was very happy with the direction of this. If this is rising, then financial conditions are getting tighter, lending's tighter, things of that nature. When it's dropping, as it is here and rather quickly, then it basically loosens things up. It's inflationary and basically going against what the Fed's trying to accomplish. Why is it loosening so quickly? Well, Janet Yellen. The more of the T-bills and stuff that she issues, it will literally, the biggest driver, the biggest connection to this is the ability to drop the rates, the yields, right? And we've seen about a 50 basis point cut in yields. So the Fed just got done talking about how the market was going to do the heavy lifting for them, and the rates on the long end of the bond curve, the 10s, the 20s, the 30s, was heading well over 5%. And then Yellen came in and she dropped yields by about 50 basis points. So now what we have is a situation where the Fed's going to have to get back into defensive posture, and they're going to have to probably, people aren't really pricing in a hike for December. I think you have to be very careful. The minutes are coming out this week too, and I think you have to be very careful in listening to what Powell or the board says regarding potentially bringing hikes back. Because people, normally when you get two pauses, the hikes are over. But I think what's happened here is Janet's pushed back the normal flow of things, which would have us rolling over into recession because of what she's done. I think she's pushed things back a quarter or two. So I think the Fed is going to have to get defensive again, where they thought maybe they would be pausing and having the market and the yields rise on their own. So that changed things. And so that's, now we're dealing with that dynamic. And to put this into perspective, here is the red step line is the Fed funds rate. And you'll notice, they're marching up. There's a lag there. Obviously, financial conditions were pulling back, then stabilized, and then started pushing back up there. And you'll notice that this recent reduction in financial conditions, what has it done? It's basically neutered most of that rise in Fed funds rate from the beginning of 2022, basically. And so now there's a battle going on between Yellen and the Fed. Obviously, Yellen wants looser financial conditions because she wants the markets and everything to be going up into the election. The Fed, they're a political neutral type entity. They always claim that their mandate is keeping inflation in check, keeping employment in check, and they're losing the battle on that. So what Yellen's doing is very inflationary, and the Fed now has to come back and tighten more, I think. So what does that mean for the market, Bob? I'm going to throw it back to you.
Yeah, and just so I can explain to people what Yellen did, why it knocked off the base. It knocked off the long end, not the short end.
Right.
Powell controls the short end. Yellen controls the long end because she just refused to create more supply there. So it was a supply and demand thing, and it had the net effect of a rate cut. And so everybody's into this situation now. We're like, whoa, we just got some sugar. And this next chart I want to show you is this is the consensus now, what people think is going to happen next year. And so, we pushed down, and now we did this rip, okay, up to 450, and it's stalling there a little bit. Everybody's expecting a bit of a pullback just because of, natural ebb and flow. Although if you listen to the Twitter quant guy, been calling this pretty well. Don't expect a big pullback. And then you're going to see this lift into January. And then from there, all the, what they call the derivative flows, and all the derivative flows are, the way this works, Phil, as you know, is that if you have entities out there selling naked puts into the market, meaning that they're making a bet, I'm going to sell for cash that the price of a certain stock won't come down to the price I'm selling against. It's a bet. When they do that, they force dealers to go long the market to be able to protect their positioning. So they create a natural lift into the market. And that's just been getting more and more and more insane. Well, that culminates into the new year. And that's why everybody's thinking we're going to get the blow off top into January. The only thing I quibble with you on, Phil, is I think the Fed's going to have to raise rates again. I just don't think they're going to raise rates in front of Christmas. And it may tie right into a January meeting, January OPEX, where he can get the most bang for the buck to knock out some of the speculative juices here. So that's what everybody's thinking right now. Now, if we do get a December rate rise, that may blow this up a little bit. If we get a geopolitical issue, that may blow this thing up. But all things being equal, there's just a mountain of unseen bets being placed in the market that's just forcing stuff up into the end of the year. You got the dash for trash, meaning anything that's shorted is being bought to blow those guys out. You got the put sellers blowing people out, and you got the zero TTE blowing out shorts. So it's hard to short this market. That's why we just said, look for your opportunities to go long into the 1st of January. And then, Phil, I know we didn't bring this chart up, is that we're likely to run out of bank juice by the end of January too, because the reverse repo they'll be drained to zero. And that'll force the Fed to have to get into the market to buy these bonds, because Janet Yellen's going to keep selling them, and the Fed may boycott that. Because the Fed's not required to buy bonds, only banks are. So it's going to get really, really interesting fast. If the banks have to start buying Janet's T-bills and they have no reverse repo left, they're going to demand higher rates to take on that risk. Or they're going to have to sell other things in their portfolio to buy those bonds that are coming out. So in the long run, she screws herself, Phil. I'm going to throw it back to you to show a liquidity chart.
Yeah. So, basically what drives this market ultimately is the liquidity. So we have to look at like the net effects of everything we've talked about. We've got the dynamics between the Fed and the Treasury. And ultimately what we're concerned with is how does that net out into what's flowing into the market? So part of the reason why we think that this is going to pull back is, one, we're getting somewhat overbought. We'll show some breadth readings here too as well. But you guys can see, if you look on the chart, what happened here, we got a risk on signal at this point, even after this move up. That's simply because the liquidity stopped pulling back and started going back higher. And that, you're going to have ebbs and flows in the market regardless of liquidity, net liquidity from the Fed. There's funds and things like that, CTA flows and things like that are outside the scope of the net liquidity. But net liquidity ultimately makes its way into the market. So you want to be on the side of it. If it's pulling back, then you want to be cautious. And then if it's starting to turn back up, you got to be bullish. So, risk on fired back here, and we've just been pumping ever since. Now, one thing I like to look at is breadth readings when I'm looking at this. In terms of the market itself, it's obviously ebbing and flowing. There's a lot of catch down yet to be done, because if we look at fair value, which historically ebbs and flows around net liquidity, fair value is way back down here. So we're, between, we're over 500 points over fair value. And I do think eventually in Q1 or Q2, we're going to get a decent pullback and probably get back to fair value. Some of your best buying opportunities, though, are when we're under fair value and get into these lower capitulation type areas where we're way under fair value. The market does not like being under fair value in terms of liquidity flows. So those are just gimmies in terms of swing trade longs, because you'll get another return back to these euphoric levels over time. But that being said, let's take a look at some breadth readings real quick here. This is another set of breadth readings here, where over here we've got the short-term breadth readings, and over here we've got more longer-term breadth readings. So in the short term, like the liquidity chart we showed you previously, we're kind of tapped out here in terms of breadth. And usually when we get up into these levels, market's going to have maybe a 2-3 day pullback. Now it can continue to go higher like we had here, because as you can see, the longer-term breadth isn't tapped out. Now when this gets tapped out into this area of resistance, this is where I typically look for a longer-term pullback. Now sometimes it takes a couple stabs to play out. You can see like we get up into these areas, you can see a little bit of a head and shoulders pattern actually on breadth itself, and then we get larger pullback. So once we get up into these areas, you got maybe a week or two, and then you're going to see a significant pullback. And this might play into what we end up dealing with in January, right? So we're well through November. We might spend December cranking up into this area, dance around up here into the middle of January, and then we get this bigger pullback that comes back in. And who knows, maybe we get data that's deteriorating in the jobs market, and the market itself, the stock market, is really getting scared about, potential recession at that point. If they're getting scared about if that's the headlines we're hearing, then it's already done. We're already well within it, and we probably have already started. Now with this market, if this continues to grind up on the longer term breadth readings, we can easily take out the previous highs up here at 4,600, and we could even press towards 4,700 as well. So we like to keep an eye on these intermediate breadth readings because those things tend to help us out. Now, Bob, I don't know if you had any comments on that, but I was going to switch over to the kind of the dynamics of what's been happening, and everyone's trying to understand why is it being irrational and bipolar? Well, if you guys notice this shaded area here, this is when the debt ceiling was raised and Yellen started issuing T-bills like there was no tomorrow. This blue line, this thicker blue line, is the reverse repo inverted. So what happens is when a reverse repo drains, it's bullish typically for the market because liquidity finds its way into the market. I flipped it upside down so it moves with the market. And as you can see in orange, the S&P 500 moved up with it. You can see a pullback in the reverse repo reading, and the market pulls back, and then we take off. Now, everything was matching up pretty well until we got to about this area here where the stock market took a pretty strong dip. That's the recent move down to 4,100 that we had. And you'll notice reverse repo didn't really dip. It stayed sideways, but then started to move higher. So we had quite a bit of a divergence here. Now, why is that? Well, if you guys recall back in October, Yellen got back to issuing the 5s, the 10s, the 20s, the 30-year bonds. Those auctions were issuing out a lot of supply. And so we had this pullback. Well, guess what happens again next week? We start going back into that cycle again where we have long bond auctions. We've had about a 10-day break in that. And so the market had a bit of a pause, recess, if you will, and was able to move up quite a bit, exasperated by CTA flows that came in. So we are expecting a pullback here. I think ultimately that gets bought. And I think Bob thinks that too. And then all things being equal, right? Because, you do have geopolitical risk. So heaven forbid a nuke goes off or something like that, right? All things being equal, pull back, and then we're probably going to get a final push out of this move. Now, the other thing that you guys have to consider too is what happens with the yield curve. Now, what Janet did was this yield curve was steepening, Bob, and she, with the financial conditions loosening because of her QRA announcement, this dropped dramatically back down. So we look like we were heading into, and I can zoom in here on the actual yield curve. If we look at the actual yield curve, you'll notice that we almost started getting toward par, right? The steepener. And then we had this pullback. This is Janet's doing. So it's what I think we need to do, Bob. We can, you can talk about the dynamics and we can show them exactly how it's all related and how it works. But ultimately, at the end of the day, I think this is a summation of all of that stuff under the hood. And honestly, we're on par with typical historic steepening schedules. We got a little bit ahead of it here, but so what this is telling us is maybe we're going to be seeing this go to par at some point in Q1, and that's with pretty good accuracy a recession confirmation indicator. And we're bucking kind of the projected trend here, but I do think ultimately we catch down to this projection, especially when we start getting into this Q1 area. And I think ultimately this is forecasting where I think the markets are going to be headed by the time we get through the first half of next year.
Yeah, I totally agree, Phil. I have nothing more to add. She knows exactly what she's doing, but she's basically playing a loser's game. And I don't know if she's going to time this in such a way that it could be the worst possible outcome for her political party in 2024.
That's what remains to be seen, because if her timing is wrong, it's going to be atrocious going into the election year. And, election years aren't a gimme in terms of the market. We've had some really horrendous crashes going right into that November timeframe on election years. So she's either doing something very brilliant that remains to be seen, or she's just, the timing's completely off here, and everybody's going to have a pretty volatile year ahead of them. So
I agree. I count on Yellen doing the wrong thing like she always does.
Yeah.
But with that, guys, we're done for the weekend. Give us your thoughts on this. I think this is all that really matters now for you guys for the next 3 months. Forget earnings, forget everything. You just got to watch these flows. There's just too much leverage and money in the system right now, and where it ends up in hiding is what happens to the stock market. So hit like, hit subscribe. If you want Phil's liquidity report, does one every night. You can also buy access to this actual indicator if you want. You can join our rooms. We have Black Friday specials running right now. We've been getting tremendous interest in what we do. We'd like you to join us because what we charge for the service is nothing to what you get out of it. With that, have a good one.
Trade Genius.